Welcome to the Deep Dive. If you need a shortcut to being well-informed on the most complex corporate stories, you are definitely in the right place. Today, we are Talk Tickers, and we're plunging into the Q3 2025 earnings call of a major industrial equipment giant. And this isn't just any company. They're in the middle of a massive, really strategic portfolio transformation.
Yeah, this is a textbook value unlock story. Our mission today is to, cut through all the noise this quarter generated.
Yeah.
There was a lot of noise. We want to figure out if management's aggressive restructuring plan, splitting up three very different business segments, is actually creating value or if it's just, creating complications. The whole narrative is about execution. Can they do this while market demand is so uneven?
Okay, let's start right there with the immediate snapshot of the results, because on the surface, the headline financials looked, well, really strong. They delivered an adjusted EPS of $2.37.
Right.
That significantly geeked the consensus, which was what, 203, a huge beat.
A huge beat. And sales were strong too.
Yeah. Net sales clocked in at $982.1 million, also comfortably beating the $957 million estimate. So based purely on those numbers, you'd think the stock had a great day.
And it did. For about 30 minutes. The stock saw this really meaningful pre-market pop on the headline numbers. But then reality set in. The complexity just took over.
What happened?
Investors had to suddenly digest the biggest piece of information in the entire report. A massive, and I mean massive, accounting-driven non-cash impairment charge.
A $709.1 million charge.
Exactly. A huge number.
Wait, hold on. For those of us who aren't corporate accountants, what does a non-cash impairment charge of that size actually mean in plain English?
It's basically an accounting maneuver that signals management's intent, their conviction about a sale. This specific charge was tied directly to the strategic review of their residential kitchen segment. So essentially, management is admitting that the real market value of that business is a lot lower than what they had it listed for on the balance sheet, the book value. They take this impairment to sort of clear the deck, write down the value before they try to sell it or spin it off.
And the key part is non-cash.
Critically, it's non-cash. It doesn't affect their day-to-day operations. It doesn't touch their available cash. But it led to this spectacular GAAP loss of a negative $10.15 per share.
A $10.15 loss per share under GAAP, that is a staggering figure. That definitely grabs headlines. So was that huge loss the reason the stock tanked?
Precisely. The noise from that one charge completely swallowed the operational beat. Investors just out about it. They moved right past the good adjusted earnings. They focused squarely on the scale of the accounting mess and the underlying risk. Can management actually pull this off?
So the stock faded.
It faded sharply intraday, erased all that pre-market enthusiasm, and it ended up closing down 2.8% on the day. It's a clear signal of cautious sentiment. The market sees the operational strength, but it's discounting the execution risk. Big time.
That really sets the stage for our deep dive then. Let's pivot to the operations side, because even there, things are a bit confusing. Overall sales growth was up 4.2% year over year. But once you strip out acquisitions and currency, organic sales were basically flat, down just a tiny bit, minus 0.1%.
And that flatness, it hides three very different stories playing out across the three main segments they're trying to split up. This is where you see the winners and the clear losers. First, let's look at commercial food service. This is the core engine, the reliable cash generator.
Cash cow.
Exactly, the cash cow. It posted sales of $606 million, and it delivered, modest 1.6% organic growth. The margins here are excellent. The best in the company, actually, 26.7% adjusted EBITDA.
So where's the growth coming from?
It's coming from their dealer partners, institutional customers, and the smaller, hungrier emerging chains.
But the big headwind is coming from their biggest customers, the major quick service restaurant chains, the QSRs.
Right. Exactly right. The biggest QSR customers, think of the global burger and coffee giants. They are still struggling with lower foot traffic and high costs. So their spending is volatile. They're delaying orders for new equipment. And on top of that, the segment's strong margins are getting hit directly by tariffs.
Let's move to the second segment, residential kitchen. This is the one tied to that massive impairment charge.
This is the one they are determined to sell or get rid of, Organic sales here declined slightly by about 0.5%, and the margins were much weaker, around 9.8%. And even inside the segment, it's a mixed story. The premium indoor brands did well, they saw healthy growth, but the outdoor product line and the overall margins got hammered by tariffs and, critically, by delays in their operational consolidation.
So they're trying to streamline manufacturing and it's just not going smoothly.
It's been slow, which is why they made a point to mention this new facility in Greenville, Michigan.
Right, the new state-of-the-art facility. Is that part of this streamlining effort?
It is, and it's a really key detail. They're calling it their new refrigeration center of excellence. The idea is to streamline operations and boost margins long term. But what's really important for investors is that getting this segment cleaned up is a precursor to the sale.
Makes the asset more attractive to a buyer?
It makes it much more attractive. The impairment charge, the new factory, it's all about making this segment palatable for a separation. And finally, we have food processing, the segment that's set for a tax-free spinoff. This part of the business had the worst performance this quarter. It contracted by 5.5% organically.
Oof. A negative 5.5% decline is rough. What's driving that pressure?
It was lower U.S. volume, tariffs, and a tough geographic mix. But what's fascinating here is how management is pivoting the whole story to the future. They kept highlighting a strong incoming order rate and a growing backlog.
Okay, so things are looking up.
That's the story. They say it's driven by improving international demand and customers finally moving forward on deferred projects. They're painting a picture that the worst is over and that they have strong visibility into 2026.
And to back that up, they mentioned a new innovation center in Venice, Italy. Why does an Italian innovation center matter for a U.S. industrial company trying to spin off a slow growth unit?
Because it's about differentiation. This center is focused on advanced food processing tech. Management is saying, look, this isn't just a pile of old factory equipment. It's a high-tech international growth business. They're building a new identity for it, so it gets a higher valuation when it's on its own.
Okay, speaking of pressure, let's talk about the elephant in the room, tariffs. Management was crystal clear this is a major, immediate drag on the business.
A huge drag.
Tariffs created a $12 million EBITDA headwind in Q3 alone. The total annual cost is estimated at $150 million.
$150 million. That is a staggering amount of money just flowing straight out of profitability. Which raises the big question the market is asking. Can they actually get that money back?
Well, management made a big promise. They said operational initiatives, shifting supply chains, insourcing, using their factories in Mexico, plus pricing actions, are expected to fully offset that annual tariff cost.
By when?
By the start of fiscal year 2026.
That is a critical proof point.
Yeah.
But it's also, highly aspirational earnings call talk. Offsetting $150 million through internal cuts and price hikes in this market, that's a huge lift.
So you're skeptical?
I think the street is skeptical. They did some price hikes in Q3 and are planning more for Q1 2026. If they hit this target, it's a massive tailwind for the stock next year. It justifies the valuation. But if they miss, it just fuels the skepticism. Everyone is going to be watching that $150 million number.
Let's shift to capital strength, because despite all the noise and these headwinds, the company's ability to generate cash is still really strong. Operating cash flow hit $176.3 million for the quarter, leading to a strong free cash flow of about $156 million.
And that cash is funding a very aggressive capital return strategy. This is their strongest signal of conviction. Year to date, they've used $500 million to repurchase 3.5 million shares. That's 6.4% of the entire company.
And they plan to keep going.
They do. They explicitly reiterated their goal to use the vast majority of free cash flow to retire 6 to 8% of shares annually. They are putting their money where your mouth is because they believe the stock is, and this is a quote, significantly undervalued.
And are they torching the balance sheet to do it?
No, and that's the impressive part. Net leverage is healthy at 2.3 times, which is right in their target range. That's actually pretty conservative for an industrial company this size. They aren't risking the core business to fund the buybacks.
So they're just using their massive cash flow to shrink the share count, which should provide a floor for the stock price.
A strong floor, yeah.
Okay, so that floor is in place. Management's conviction is high, but the market reaction tells you investors are still skeptical. Looking at the guidance, Q4 and full year 2025 revenue guidance is actually a little below what Wall Street was expecting.
And that cautious forecast ties directly back to what we were talking about with the segments. Management openly admitted that the big QSR customers are still pressured. They're basically telling the market, we can't bet on a fast recovery in fast food traffic, so our forecast is conservative. It's prudent, but it also explains why the stock isn't re-rating higher right now.
So if your biggest customers are challenged, how do you actually unlock this value they keep talking about? It has to be more than just spin-offs.
It is. It's a multi-pronged approach. First, you have the hard catalysts, the portfolio simplification. Value unlock number one is the food processing segment. That tax-free spinoff is not just some vague idea anymore. It is on track for the first half of 2026. They specifically said transaction effectiveness is anticipated in May 2026.
That's a fixed date. The market can measure them against that.
Exactly. And the second catalyst is the residential business, the one that triggered the big charge.
Value unlock number two.
Right. The formal review is underway. And separate reports have linked Josh Harris's firm, 26 North, to a potential $800 million deal for this division.
Wow.
Yeah, that rumor just underscores the potential for quick monetization. They want to turn this headache into a huge pile of cash they can use for more buybacks.
Beyond the spinoffs, what are the internal growth levers? How do they drive sales when QSR traffic is down?
They're focusing on higher margin, stickier solutions that solve problems besides just traffic. A key initiative they highlighted is their ice and beverage platform.
How does that help?
It targets new parts of the day, like afternoon beverage programs. It gives QSRs new ways to get customers in the door when lunch or dinner traffic is soft. They're selling solutions, not just equipment. And they're investing heavily in automation, electrification, and IoT capabilities to become more of a tech provider.
It's a clear plan, but looking at the last 12 months, the stock has really underperformed the S&P midcap and the broader market. The market is punishing them. This re-rating needs to happen.
It does. And I think the reason for the low multiple beyond the spinoff noise is the gap between what management is promising and what they've delivered on that $150 million tariff offset.
So it comes back to execution.
It all comes down to execution. Investors are skeptical about how long it will take to clean up residential, and they want proof that the core commercial business can sustain its margins. The stock price tells you the market is demanding proof before it pays a higher multiple. This is the deep dive, and this is not financial advice. Please consult your financial professional before making any investment decisions.
Okay, but if we were sitting in a hedge fund meeting pitching this exact report, which, showed operational strength but a ton of volatility, we would focus entirely on that valuation gap, the gap between management's confidence and the stock price.
The trade setup is pretty compelling. The market is clearly discounting the stock because of the execution risk on the two big strategic moves. But the underlying free cash flow generation is undeniable. And that aggressive 6 to 8% annual share reduction target provides a powerful structural floor for the price.
And the fade on earnings day shows that gap is still there.
The gap persists. But you have these two hard, confirmed catalysts looming in the first half of 2026. The food processing spin in May, and the outcome of the residential sale.
So the audacious but plausible pitch is to leverage that specific time horizon. But why mid-2026? Isn't that betting the farm on them hitting a May deadline that seems, optimistic?
It is a high-conviction bet, but they explicitly put that May 2026 date out there.
Yeah.
The idea would be to pitch a long position in deep out-of-the-money call options expiring mid-2026.
So you're buying long-term upside.
You're buying volatility and maximizing leverage for the re-rating that should happen once two things are clear. The food processing spin terms are final, and the residential outcome is announced. You're betting that once the strategic noise is gone, the stock snaps quickly toward that 168 analyst price target.
So it's a time-bound bet. It hedges against near-term macro weakness, but leverages the confirmed timeline.
Exactly. It's a bet on strategic clarity.
That is a high-octane trade based entirely on the promise of structural change. So let's bring it all back together. This was a quarter defined by a big adjusted beat, but it was immediately overshadowed by that massive non-cash impairment charge. We saw strong free cash flow fueling aggressive buybacks and a clear, aggressive timeline for simplifying the portfolio.
All right, so the question for you, the listener, to mull over is this. Given that the stock has lagged the market by so much over the last year, despite management's extreme conviction, which catalyst is going to matter more to investors in the next 6 months? Is it the confirmation and the final terms of that May 2026 food processing spin? Or is it management successfully proving that they're on track to fully offset that $150 million tariff headwind?
The timeline is concrete, but the profitability is conditional. It's a fascinating look at the risk and complexity of these big industrial transformations. Thank you for joining us for the deep dive.